All right, so now we're going to take some time just to look at this section. We used to call it prognostications, but we realized that we're actually not good at making prognostications. We're never going to get predictions right. And really, we should be structuring our affairs so that we shouldn't need to predict. We take the temperature, and we always err on the side of caution. But let's just try and get a snapshot of where we are now. So we show you the slide every year. We're calling it mean reversion misbehaving this year. So just to summarize the slide quickly, we believe that prices always go back to the average because price movement makes up the average. So Toronto house prices have gone up by around 7% a year since the 60s. So all we've done here is plotted in the black line, which is the average house price increase of 7% a year. And then we track the actual house prices and use that as a measure of how hot or how bubbly the market might be, or how much value there is in the market. So if you recall our AGMs from 2016 and 2017, we were concerned then. We had the same kind of thing where we showed the little red arrow with how much prices were deviating from the mean. And we started taking risk off the table in 2016. That served us well because prices then went down. This happened again now post-COVID, but at a greater magnitude because there was more liquidity flushed into the system. So prices peaked at 51% above the mean, which was significant deviation. We had already started taking our foot off the gas prior to that. And so the decline in prices didn't affect our portfolio too much. And we were starting to get excited because as prices come back down, it means that you've got less downside and you can actually get more aggressive about lending. So we thought we would have a better lending opportunity because prices came down to only 8% above the mean. But now they've started ticking up again to 14. And so we're continuing to maintain a defensive posture. We would be interested if we can see prices at or below the mean, we would be interested in increasing our risk appetite, but we're not there yet. Just a quick look at this almost as like a supply demand type slide. Prices have come down. They're actually down less than they were before. What's interesting about this slide and why you're seeing such a big increase over the last quarter is when you look at the inventory in the far right, normal inventory is usually 4 to 6 months in a healthy market. It's very, very tight right now. You've got about 1 month of inventory. It is ticking up a tiny little bit now, which may start to mean price increases will slow down, but we'll see what happens there. But inventory is still very tight. Interest rates also, which usually are a driver of real estate demand, are extremely high. They're the highest they've been in almost a decade. They've gapped up significantly over a short period of time. And so we will have to see what kind of impact this has on borrowers. Interestingly, in Canada, households are actually highly levered. If you looked at the gray line, this is household debt to GDP. The gray line is the US, the blue line is Canada. In America, they were forced to take their medicine in 08 and 09, and they delevered. In Canada, we didn't really have a reckoning. We kind of flatlined our borrowing and then started to accelerate it again. So we have interest rates gone up in a period when households are quite highly levered in Canada. So something to keep an eye on. We're believers that liquidity is a big driver of prices. When you have a lot of money being created, it chases goods and services. If there's more money available than there are goods and services, then the prices of goods and services go up and you get inflation, which is what happened. And what you can see, this is the Fed's balance sheet, which is one measure of liquidity that's being created in the system. And you can see in 08 and 09, which was the great financial crisis when we almost had financial Armageddon, and the Fed had to step in to bail out the financial system. You can see that at that time, it was an unprecedented stimulus. They called it QE, and then QE2 and QE3. What's funny is that when you look at that, which was unprecedented, it looks like a nothing compared to what's happened now post-COVID. So you've had now an unprecedented creation of liquidity. Now the Fed's turned around and said, we've got inflation. We're no longer doing QE, quantitative easing. We're doing QT, quantitative tightening, and they're taking money out of the system. They started to reduce their balance sheet when SVB Bank went under. They popped liquidity back into the system. Now they're trying to take that out, that little squiggle that you see on the far right. But they've started to reduce their balance sheet. It's been around a 6.5% reduction. In Canada, the Bank of Canada has actually been much more aggressive about reducing liquidity. they've reduced the size of their balance sheet by 36%. So Bank of Canada has actually been much more aggressive, both in terms of interest rate increases. They were the first to lead with interest rate increases, and they've also been more aggressive in contracting their balance sheet. So that is all deflationary. It takes money out of the system. And we believe you got to keep an eye on that because it'll impact home prices, or it could impact home prices. Another interesting metric that Howard Marks loves is the real Fed funds rate. And basically what it's saying is, what is the Fed funds rate less inflation? And if the real Fed funds rate is negative, it's stimulative. And if the real Fed funds rate is positive, it's contractionary. And for a long time now, it's been stimulative. For inflation to start subsiding, you need to see that being a positive rate. You are finally starting to see that. So that's an encouraging sign, and it's worthy of keeping an eye on that as well, especially as they continue to increase rates at the Fed and Bank of Canada level, and inflation declines further, then obviously you get more into the positive territory for the real Fed funds rate. This one is a really striking chart. We wanted to look at liquidity gets created, it gets deposited at the banks, and the banks use those deposits and they lend out, and they multiply capital through the system, which is how you get velocity of money, which is one of the components of inflation. In America, you've had almost $1 trillion of deposits leaving the banks since the Fed started to increase interest rates. So you've had a huge reduction in deposit base, which means the banks have to reduce their lending appetites, which again is deflationary, not inflationary. And so you're starting to see that in Canada. You're seeing this. This is from our friend David Rosenberg. It shows you mortgage lending conditions. So it's banks' appetite to lend. If the red line is above the zero axis, then banks are getting tighter. If it's negative, then the banks are getting looser. Right now, they are tightening, and you can see they're tightening quite a lot. So their appetite to lend is declining significantly, and that's because they have to take loss provisions. They're looking at their collateral values going down, their deposit bases are going down, so they need to take steps to strengthen their balance sheets. Again, deflationary. Employment's actually okay. This is the unemployment rate, but we have to keep an eye on that because that's one of the drivers of real estate. But as things stand today, employment's actually doing okay. This is a very powerful chart. It doesn't include condos, but for single family housing starts in the GTA, we are producing fewer houses. If you look at the green arrow, that's the trend. The housing starts are lower than they were 20 years ago, but look what's happened to population growth. It's exploded. So you have a population growing at the same time that policymakers have made it very difficult to create new housing supply, and therefore land values have gone up too much, and so it's not economical to create significant new housing supply. So we feel like that is really bullish long term for any owners of real estate in frankly probably in most places in Canada, but certainly in the GTA. Looking at Ontario population growth, if you look at this chart, just look at the orange bars. That's your quarterly population growth. Just look at the change. There was kind of a trend before, and now the trend in population growth is significantly higher than it was historically. So that obviously will impact the supply side of your supply-demand curve as it relates to, the demand. It'll impact the demand side of the supply-demand curve as it relates to housing in Ontario. Okay, so just to summarize everything, these are the takeaways we hope you will walk away thinking. We hope you think that we're good stewards and that we zig while others are zagging. We hope that you feel like we're taking good care of your money and that we're focused on long-term and consistent returns. We also hope that you see that great opportunities are coming. This is a time when fear is going up. People are going to be scared and less willing to put capital to work. And that's exactly the time when you want to put your capital to work, because it means that we're going to get higher returns going forward. And as long as we navigate the risks, we can do really, really well, especially if we have a long-term focus. And finally, we feel that you should take away that the fundamentals for real estate are really strong. We have record immigration and insufficient supply growth, which puts a floor under prices. So we don't know what's going to happen in the short term, but we're very confident that in the long term, prices of real estate will continue to go up.